Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial updates. I'm your host, Swaraj Rajagopal, and we have got you covered on everything from currency shifts to pivotal central bank decisions and important speeches. Plus, you'll gain expert analysis on macroeconomic data that's shaping the market narrative right now. Join us for this episode and navigate the markets with confidence. It was perhaps a very consequential day for the markets. Stocks down across, yields down across, and the yen carry trade unwind narrative was floated around strongly across the markets. Good morning, JK. Please break down yesterday's move for our listeners.
Hey, good morning, Swaraj. I think it was a heightened volatility in the last 2 days, and definitely the risk-off sentiment was in full play. Just imagine Japanese stock market falling around 30% in 10 days. And of course, we had also a reversal of 10% in one session today after, market realized that they had carried the carry play unwind too far. Yes, authorities are also getting concerned about these moves yesterday, and there were voices heard about, they're watching the market very closely and all that. Yes, the initial reason was quite, credible because there was a lot of softness seen in the US data on a continuous basis, and fears of recession had risen again. The key word here is only the fears, and it's not actual recession. Because as we pointed out yesterday, there have been many indicators which show that historically they lead to recession, like the yield curve inversion or the SAM rule on unemployment rate. However, these are not guaranteed, outcome of recession, and on mere expectation, the market selling of in 30%, 35% in quick session was something that was not justified. Yes, that's the way the markets operate nowadays. They overdo things on either side, and also the positioning itself also weighed on the market because there was massive carry positions that were built up against the yen in almost all the asset classes, and right from the Bitcoin up to the Indian stocks, there were unwinding that was seen. But I think large part of that has been, at least for the time being, seen. The Japanese rate hike, of course, was the biggest trigger because that was least expected about a month back, and when they actually did that, then I think there are a lot of highly leveraged positions have got unbound. Yes, I think the sentiment carried over from Japanese market to all other markets, and then even in the US, at least till yesterday, closing markets did not recover. Although we did see some encouraging data from ISM services, which was definitely better than expected, and it was better in almost all the aspects, like services, employment, and the new orders. All of them were far better than expected. So the market had to reassess its own expectation on how fast the economy is going to slow down. And even the official voice that was heard, Mr. Goolsbee, was saying, yes, definitely the job market was weak, but then it not really was not recessionary data, is what he was saying. And there were good reasons for the market to bounce back, and that's what we are seeing today. And in the Japanese market are up 10%. Similarly, other markets are up as well. And we are also awaiting a key decision on interest rate from Australian Central Bank in about an hour's time. And so markets on the yields also overdid. They fell into 14-month low on both the 2-year and the 10-year, but they recovered all the losses in the yields yesterday. One is the data. Another is realization that the recession fears were overblown, and thirdly, the huge amount of supply that we have been talking about for quite some time. The yields cannot keep going down because the debt and the fiscal deficit situation of the US government that needs to be keeping on borrowing, and lower level of yields, there will be more issuances and supplies that will support the yields. Therefore, yields also bounced. On the currencies, for a change, euro was one of the safer bets and it rallied to almost 1.10, whereas the dollar yen continued to see unwind, rather sell off, almost touching 141 yesterday, which was more than a 10% drop from the peak that was seen. And since then it has stabilized along with the risk assets improving. And the commodity currencies were hardly hit because of the slide in the commodities. We have seen some mild recovery in all the asset classes. Yes, I think this is all the herd mentality that affects all the markets. Now, it's a very big rarity to see talk about rupee volatility, and that was in evidence yesterday. A gap up open in USDINR above 83.80. Surprisingly not retraced because the central bank was not seen selling in offshore and continued buying in the intraday, mostly from foreign banks acting on behalf of FI outflows. Data from NSE showed as much as 1.2 billion worth of shares were sold by FIs. Yes, the carry unwinds not only against yen but against other low yielding Asian currencies was also seen in Indian markets. That was clearly evident when you look at the performance of rupee versus other Asian currencies. Asian currencies were recovering along with yuan and the yen, but rupee was weakening. So this clearly evidence that the lot of rupee assets had been bought by selling those currencies, and they were getting bought back also. Indian shares also fell about 2.5%, but that was definitely dwarfed by the major moves in the global markets. Rupee did close at an all-time low of 83.8450 on onshore trading, but the floodgates opened after the OTC closed when it shot up as high as 84.14. Yes, broke 84 psychological level, and it was a 30 paisa move from the closing level. Again, no intervention was apparent from the central bank in the offshore market. Although in recent updates, we have seen the rupee recovering to around 84 levels after the bounce back in the risk in the global markets. It's too early to conclude whether the central bank has changed its policy on the currency being kept stable. We can see that when at least on days of large flows, they are allowing the market to find its level. And we have been updating quite often that whenever there is large outflow or there is a big inflow or a big fall in the dollar index, that is when the central bank allows the rupee to move, and that was in display yesterday. So even then, the outsized move after OTC hours may not sustain, and we may well see the offers coming today to keep it closer to 84 unless there is another day of big sell-off. The big sell-off in FI selling might continue because, if not, maybe with a break, because the position in Indian markets is also huge. But overall strength of the Indian economy and the macros will help the markets to, even stabilize much quicker, depending on how the, global markets perform. Finally, geopolitics, a lot of fears again, but no major events were reported. And the happenings in the neighborhood, Bangladesh, was also something that investors were looking with a lot of interest. And it's an ongoing event, so that we'll have to assess what impact it will have on the Indian economy. Thank you.
Thank you, JK. And of course, the Japanese carry trade unwind narrative was strongly seen in yesterday's markets. Japanese stock market down more than 30% in the last 10 days, but today, in fact, it has recovered 10%. So a lot of volatility going on. And of course, fears of recession has resulted in some of this volatility. But such fears, as JK mentioned, are fears now and not the actual recession. ISM services PMI from the US was actually quite good. This also resulted in markets reassessing their concerns and coming to the realization that maybe yesterday's moves were a little to the extreme side. For rupee, there was a gap up opening and continued buying of the dollar due to FII outflow. But despite a recovery in the Asian currencies, rupee traded weaker. And in fact, after the OTC close, we did see rupee weakening as low as 84.15. Indian equities also fell by 2.5%. And of course, geopolitically, there is nothing, but the events in Bangladesh are also in the limelight. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.